All right, guys, before I even get started, I want to make sure that you guys do understand and see my disclosure statement right here on the screen. What this disclosure statement tells you is that I am not an investment advisor. Anything I show and talk to you about today is for educational purposes only. So if you decide to take upon anything that I am talking about today, please do consult with your own financial advisor, and they can help you to understand the relevant risk factors when trading futures, Forex, or whatever market it may be. All right. Now, as always, guys, before I get started, I want to give you a word of encouragement, a word from the Lord. And today we're going to be talking about Joshua chapter 7, 1 verses 7 and 9. Joshua 1, 7, 9. Be strong and very courageous. Be careful to obey all the law my servant Moses gave you. Do not turn from it to the right or to the left, that you may be successful wherever you go. Keep this book of the law always on your lips. Meditate on it day and night, so that you may be careful to do everything written in it. Then you will be prosperous and successful. Have I not commanded you? Be strong and courageous. Do not be afraid. Do not be discouraged. For the Lord your God will be with you wherever you go. Guys, about this, notice the first things that it talks about is successful and prosperous. God wants you to be successful. He wants you to prosper. This is part of the conversation that the Lord had with Joshua after Moses died. He was encouraging Joshua to be strong and courageous. God told Joshua that to be successful, he must obey the rules for living found in God's law. So oftentimes we try to be successful by doing our own thing and what we feel we want to do to get where we want to be. But just as God told Joshua, the key to success and prosperity was to obey the law. Do not turn from the law. Keep the law on your lips and meditate on it day and night. This is also the keys for us to be successful and to prosper in today's world. Remind yourself every day of God's words day and night, and act on what you know God has said, and He will assure your success in carrying out His purpose. So God has a plan for you guys, and just believe that. God bless you, my brothers and sisters. All right, guys, so I know you're ready to get started with this thing. So we're going to get started. Last time I ran through this video, it took me over an hour. I want to cut this thing down to under half an hour. So I'm going to be fast. I'm going to be detailed, but I'm going to skip over some things that are not as relevant as we go through. All right, so who was Wyckoff? Wyckoff was a pioneer in the technical approach to studying the stock market. So he was a broker, a trader, and a publisher during the classic era of the early 20th century. So Wyckoff observes price action, and when it formed at the bottom or top of the market movement, he noticed that this was accumulation and distribution. So he developed what was called this market cycle. It's a theory that outlines its key elements in price trend development, and it marks periods of accumulation and distribution, and markup, and so forth. Wyckoff studied to understand the real reasons behind the market price movement, and in his studies he realized that there was a bigger, informed, more highly skilled trader who had the ability to shape the market and completely control price. Wyckoff called these traders the composite operator, the same things that we think about today when we think about institutional traders or smart money, the smart money. Who's the smart money traders? That's these composite operators that Wyckoff was talking about. And so what Wyckoff says is all of the fluctuations in the market and in all the various stocks should be studied as if they were the result of one man's operation. Let us call him the composite man, who in theory sits behind the scenes and manipulates the stocks to your disadvantage if you do not understand the game as he plays it, and to your great profit if you do understand it. So that's what it means, guys. You need to understand what's happening with these composite operators, are institutional traders, are smart money traders. All right. So let's get going with that. So what I want to talk to you about today is the Wyckoff spring. A spring is a price move below the support level of a trading range that quickly reverses and moves back into the range. A spring is an example of a bear trap because the drop below supports appears to signal resumption of the downtrend. In reality, though, the drop marks the end of the downtrend, though trapping the late sellers or bears. The extent of supply or the strength of the sellers can be judged by the depth of the price move to new lows and the relative level of volume on that penetration. That's a lot. That's a mouthful. But I'll show you this and it won't be as mouthful as what I just said, okay? So an upthrust is the opposite of a spring. It's a price move above the resistance level. Take that in mind. It's a price move above a resistance level of a trading range that quickly reverses itself and moves back into the trading range. An upthrust is a bull trap. An upthrust is a liquidity grab. See what I'm saying here? It appears to signal a start of an uptrend, but in reality marks the end of the up move. The magnitude of the upthrust can be determined by the extent of the price move to new highs and the relative level of volume on that movement. I'm going to go through these quickly because I don't want to take a lot of your time, but I want to explain it to you very deeply. All right, so we're looking at a flat market up here. You can see this resistance point. This market formed a resistance point and a high of the resistance point. The market drops off of that resistance point and it comes back to that level. As it comes back to that level, it breaks above that level. Therefore, we call this an upthrust because it breaks above the level, but then it falls drastically below the level, trapping all these traders up here because above this level, up in this level here is a lot of liquidity. Why? Because there's orders up here, stop loss orders, entry orders long, orders short, and so forth. So they all get grabbed and then boom, the market drops to the downside. All right. When we talk about these things and when we talk about how to use this and so forth, the main thing that you want to understand is always look at the price action, where our level is, and then the volume that's occurring at that point. Because the volume is going to be able to tell you a whole bunch of what's happening. Because volume is something that Wyckoff really studied a lot. And he said he had these 3 laws. And one of the laws is effort versus result. Okay. How that law goes is like this. When you have volume, that volume bar is basically the effort. If you put out a big volume bar that's going to be a big effort, then you should also put out a big candle bar that's going to be the result of that effort. If they don't match or they don't line up, it's telling you something drastic in the market. All right. So as we go through, I'll talk about each concept of the volume associated at these levels and what to look for. So all you're looking for is to find the high of your support or the high of your resistance level, right? So you're looking to find that high. And then after you find that high and have that level lined out, you're waiting to see if the market comes back and spikes above that level and then drops back down. Because what this is it shows a move on demand, but it doesn't show follow through. And then the market drops to the downside. So and that's your opportunity to catch that market. So in this case, you would have been able to catch a trade because as the market broke above this level, we could see that it failed. And then there's your price action entry below that point with your stop loss up here. All right. Again, as I said, a lot of traders get trapped up here. All right. Because they're going long trying to catch the breakout. And then also we have stop loss orders up here. And then also we have limit orders up here. And so therefore the market comes up what's called a liquidity grab, which is also called this upthrust. And then boom, drops to the downside. Your opportunity to make a trade, get into a pretty good trade at that point. All right. So the next one we're looking at a spring. So basically the spring is the opposite of what you just saw. Just because previously we were looking at resistance, now we're looking at support at this yellow level here. So you could see the market made this low here and the market comes back and tests that low. This low is support. All right. Because the market moved off of that level. So we consider this support. Then the market comes back to test this level again. But during the test, it breaks below that level. And it breaks below on high volume. All right. So remember the things that we talked about with the high volume and with the effort and the result. So this case, the effort was big. And the result was big because we're looking at the spread when we talk about the result. So the result looked good also. But the only thing with the result was where it closed. We want to see if that's going to be strong supply coming into the market, then it should close on its low down here, not approaching its midpoint. Okay, we don't even want to see that, because then we know this gives us clues that maybe this is not as strong of supply as we see. There might be a lot of demand coming into the market at this point. So the next candle is what's going to be relevant. It's going to show us what's really going on. And the next candle does show demand coming into the market. And you could see the buildup of demand coming into the market. Boom. All the way till we get up to this level. And we had that buildup. In order to move off of this level, you have to have gas. That gas is the increasing demand, which is the increasing volume. Shows you on the volume chart, on the volume bars. All right, you want to see an increase. If you see a decrease, then you're not going to push off that high. That means the smart money is not with that move also. All right, so that's a very good thing right there for you to understand and know. So that's going to be your spring. Here's another look. This now is the opposite again. We're back at a up thrust. So again, remember, the up thrusts happen at resistance points and the springs happen at support. In this case, we formed a resistance point as the market flattened out up here. Then the market drops off of that level again, pushes back up to that point a little bit. And the process gives us major big supply bar, a big demand bar, sorry. So when we see that demand come in here, we're thinking that we're going to break this level. So a lot of traders, again, jump on the boat here. They're trying to trade that breakout. But the very next candle shows us major supply coming into the market. Now, again, when I look at that, I don't get the effort on this red bar. I get the good effort, but the result's not that good. But you can see what happens. The market drops off. All right. And it didn't drop off too hard because we had declining volume. Well, actually, like this volume was bigger, but the next one dropped off a little bit, but was even, our result was a little bigger. And then we had a little bit of increase to finish off down here, came down to this low. All right. And then the market pulled off of that level. So these multiple highs, multiple lows, these are going to be relevant areas. Basically, these support and resistance levels are going to be basic relevant areas that you want to be really aware of and watch what happens at that point. Don't get caught in a fake out, because basically these are fake outs, really just going to be traps for you guys, bear traps and bull traps. In this case, it would be a bull trap. All right. So you don't want to get caught up in those traps. So therefore, you want to pay attention to that volume. Volume is big if you want to trade levels at certain levels. Volume is big for any time of trading. It can give you a clue as to what's happening because the volume precedes the price. All right. So again, we have right here a resistance point. We made this high right here. We consider this resistance, right? Because now the market came and tapped it again, right at the exact same level. Why not a little bit above, or why not a little bit below? Why at the very same level? You know what I mean? That's like right at the level. What's the odds of that, right? So the market comes up. At this point, it makes this big bar here that pushes through this level. What's happening right here? A lot of traders are jumping in long for the breakout above this previous high, this high right here. So they're jumping in to go long. As they go long, you can see it looks pretty good. We got a big bar here. That's what it's meant to do. These institutional traders are this composite operators. They're designed to buy to sell. Their real move is the sell move, but they must buy to get the interest in the wrong direction. They get the interest of the breakout traders. They also grab the liquidity that's above these levels. All right. They grab more sell levels, more sell orders and buy orders, because first of all, they're getting these limit orders that are sitting here. All right. And if there's any other sell orders up here, they're getting those too. But they're also getting these buy orders, these limit buy orders that are trapping these traders. And as these traders can't get out of the market, they're trapped and the market drops. And now they have no choice but to get out. And if they don't get out, they may be hurt even more. So what happens here now is that the market comes back and tests this level. So we get a test here. So in this case, you would be able to look at getting into the market. Let me show you how you could get into the market. I'm going to show you various ways to get into the market as we go through. But this is a retest of that spring of the upthrust. This is the upthrust retest, and you can see it doesn't go any higher than that level. and then the market drops off really hard. All right, so coming here, when this market breaks above this level, if you're always thinking that you don't want to trade the breakout, then you must be wanting to trade the resistance point. So in that case, since this candle breaks that high, then your entry should be below that candle. And if it never comes back, it never triggers you. Now, in this case, it would have triggered you, gave you a little profit, and then took you into a slight drawdown. A lot of traders probably get out at this point, but again, it goes down to this low right here. And now we see the market is flat. So as we watch that, the market comes back to this low, creates a multiple low right here. All right. As it comes back, hits this low 2 times, this time here, slightly below, and then crests below even deeper. The thing that you want to notice is look at these 2 bars here. All right. Pay attention to these 2 bars. Because the thing about these 2 bars, it's major. What's so major is that this bar was so big. That's the effort, and it got a good result. The next one, the effort was a little better, right? Just slightly better. But look at the result. The candle is way smaller. And then look where it closed. If the effort was that good, it would have closed down here. And it would have been a bigger bar, because that volume is having almost the same exact amount. So therefore, we should have the same size candle closing on its low. Instead, it closes near its high with a rejection. In order to enter this market, here's what you would basically do. You want to always get these price action entries if you can. You get in here, stop loss here, and you try to trade up to this level. Now, I talk about how I trade the market. When I get into the market, I keep my stop loss here. When this candle closes, I go to pretty much slightly below break even. As this candle closes, I put a stop loss here. This candle closes, I put my stop loss below there. This candle closes, I put it here. And then I put it here, and then I would be stopped out right here. All right. So I wouldn't have made my target right there, but that's the way I trade the market pretty much when I'm scalping. I pretty much do it that way on a faster moving market. So that's what we're looking at there. That was an up thrust and a spring on the same chart, because we're in a range here. You see these a lot of times in flat rangy markets, but you will see these definitely in trending markets, and we'll talk about that shortly. All right, so here's another example. I'm not going to be real detailed on these examples because, like I said, last time this video was over an hour, and I want to get it down to 30 minutes if I can. But you can see we created a high right here, and we created a flat level here. We were kind of like in a consolidated range, so we knew this was a resistance point. So that point, you could see the market spikes up there, but look what it does. Gives us a big volume bar. But that bar is a big supply. It's a big major supply bar. All right, so if that's a big supply bar, it's already showing us signs with the candle also. The candles, if that's a big supply bar, we want it like that because that's a nice size candle with a close on its low, pretty much. So therefore, we would put our entry right there with a stop loss above. We would shoot for this area here, maybe this area that lines up together. You could see where that is. Then we would shoot for this area. I always look to the left to see where I'm going to shoot for my targets. And you can see this market probably pretty much only dropped down to this area here. But I always look to my left to see where the next support and resistance level is. All right, or where maybe there's some supply and demand areas, or maybe a order block or something like that. So that's what I look for my targets. And that's how I would have traded this level right here. So that's going to be an up thrust. So let's move to the next. And in this case, this is going to show you a couple things I want to talk about in here. And it's very relevant. But as you can see, again, the market creates this high. And then the market falls down. Therefore, that creates a resistance point. Well, the market comes up to this area here and spikes through really big. Have a nice spike through that level with a really big candle. And that demand is showing strong on that candle. So our effort and result match pretty much. So I would be thinking, well, we're probably going to break this level. But since I'm not a breakout trader, I don't take that trade. What I always wait for is the market to break, come back, test, and then I go for the trade. At this level, again, I get the same trade instead of getting caught in a bad trade, getting caught in what is known as a bull trap, which is getting ready to happen right here. But in this case, like I said, effort and result match. You got a big demand bar coming in, but the very next bar, if that demand was that strong, you would not get a major supply bar coming in here like that in this kind of candle. So therefore, what we would do at this point is now put our entry below that point, stop loss above, and shoot it down to this level. That's where we would trade to. All right, so now in the process of trading, let's say we took this trade, boom, we're in the trade, we make profit, boom, we're good. So now we're not doing anything, we're sitting out of the market, we're waiting. And in the process, what happens here, guys, this is really relevant. So this market now makes what we call here a fractal, right? So it makes a fractal. This level is also known, what ICT would call this, is going to be a breaker block. A breaker block. All right, so I call this a fractal bounce opportunity, a bear fractal bounce opportunity, or I also call this a S-wave trade. If you learn more about Ichimoku, you'll understand the market structure. And this is how the S-wave forms, starting from here, goes down, pulls back up to this level. So as we talk about this level, we're not talking about an up thrust or a spring right yet. What's happening is we're getting an opportunity to trade this level when the market approaches back up to this level. We get an opportunity to trade it short. Then we get an opportunity to trade it short again, gives us good profit. And we know that we're getting good profit and trading with the trend because we're breaking bear structure. You see how we're breaking bear structure? This is the lowest bear structure. This is the highest bull structure. But we're breaking this bear structure. We broke structure, structure, structure. That lets us know we're in a downtrend. So when we approach this level again, we feel confident taking our trade back to the downside. Now we want to take that trade to these structure levels. All right. And as you can see, the market moved down. But now we get into what we're talking about again, because the market comes back for a third attempt at this level. Take notice, guys, as we come up to this level, what do you notice? Well, look at these candles, first of all, getting smaller and smaller, and also giving us bigger wicks. So the bodies are getting smaller, giving us bigger wicks. And then also coming into the level, our volume drops off, right? So look at the volume drop off at this point. It dropped off. But then we hit this level. First of all, we get this candle here. Now that might have triggered us into the possible trade. All right, but I have my entry below that level. But then we get a big demand bar. That might have faked us out, right? So we might think, oh, no, it's not going that way. But what's happening, guys, is this thing is just grabbing liquidity up here. There's all types of liquidity up here again, because basically what's up here? Stop loss orders, all right, more long orders, more short orders. So this is grabbing liquidity up here, all right. And then what's happening now, you should be able to understand what's happening now, because with that big bar, the follow through should be relevant, but we don't get the follow through. What we get is a big bearish bar, all right. And at this point, we could take this trade short. With this bearish engulfing, put our entry there, stop loss up here, and then boom, take it down to these levels again. And you make profit. Now there's ways again, I want to show you another thing about entering this market. If you believe that the market, if you trade in support and resistance, and this is a resistance point and you're going to trade it short. So the way to trade support and resistance, at support you trade long, at resistance you trade short. In this case, the market's below the level, so it's resistance. So if you knew you wanted to trade support and resistance, why, when this bull candle develops, you don't just put a entry below it with a stop loss above it, knowing that these are the types of things that happen at these levels. And either you get triggered in or you don't. And if you get triggered in, you know what your stop loss is and everything. All right. So that's the way you can trade these markets. That's what you got to look for, to be aware and look at that volume. All right. So let's move on. I'm going to run through some of these that aren't as relevant. I mean, they're all relevant, but some of them I really want to talk about the volume, help you to understand what's happening at these levels. Here we can see that price established a nice valid resistance point. Now I want to take you to the next slide to talk about this same level in more detail. All right, because now we created this level here. And again, this is so crazy because look at the level here that was resistance. But look at right here where we can't break that level. We come right to that level. I mean, like right to the level. We don't come a little bit above it. We're right at it. So let's talk about that on the next slide here. As you can see, I moved in a little closer because there's some things I want you to be relevant about, to know about. As we're coming into this level, I want you to always pay attention to the volume, because first of all, the volume is dropping off. Look at the decline in volume. You cannot break this level right here if you do not have power. The power is gas to get through that level, and the gas is the volume. Decreasing volume is not strength, it's weakness. All right, so therefore that shows that there's weakness coming into this level. All right, weakness of demand coming into this level. But see, a lot of traders are going to think that this is a good opportunity to go long. Why? Because they get this nice big bar here, not understanding that, first of all, look at that big bar. That big bar is this candle right here, is this bar right here. All right, these two bars are probably the same. This bar is probably, matter of fact, bigger than this bar. But look at the volume bars. This bar is bigger, right? And then this one's smaller. So the effort and result are pretty much in a line, but then we don't get the follow through. And then the supply overtakes the demand. Stop loss here, entry right here, and the market takes us to the downside. Definitely you could see this big rejection here. Look at the bigger candle, the bigger volume bar, much bigger than the candle that you previously looked at on the bull side. Okay, so that's an opportunity for you to catch a nice trade off of the level. And you would look to trade back down to these types of levels, you know, where there's nice support. Also looking at these upper levels where you may see the market just drop down to. So I look to my left to always find my target pretty much, or else I use a measured move to look for my targets and so forth. That's for another day. All right. So here again, I want to talk about this one a little bit, but again, you could see we have a up thrust. When I get a support and resistance point, now then in this case it's resistance. So when I get these points, I like to make zones where I have wicks. So if I have a wick, I make a zone. If anything pushes through that zone, such as we have here, then I'm kind of alerted that maybe either we're getting a breakthrough or we're getting a fake out, which is going to be a trap, a bull trap. In this case, again, another bull trap coming into that level. Look at the things that happened at this level. This is the volume coming into this level. Look at the volume of the previous bullish volume and the bars. Maybe the same here, but look at what happened on these. It didn't go anywhere. So look what happens here. And if you got strong volume, in this case, I don't consider this strong volume, but we also almost closed near our midpoint. All right, we're probably in our upper quarter, and we don't want to be closing. We want to close as close to that high as possible if we have a strong demand coming into the market. And then the next bar, a major drop off. And you probably don't catch that trade unless you trade the way I've been showing you or telling you that if you realize that this may be what you think it is, a fake out, then always have your entry ready to go. All right. And a lot of times I trade the zone because I feel like this. If we go above the zone, I'm going to put an entry right at the bottom of the zone. And I have my stop loss here. This way it can trigger me in. And I'm not, the lower I get from this area here, the more risk I have. Because I have to keep my stop loss at this level. The market's already proven where it can go. So why would I say, oh, I can afford 20, I can afford 30, I can afford 60. You got to afford what the market is giving you, and then see if you can fit that into your money management by actually probably dropping your contract size or your lot size or shares or whatever. All right. So you got to make that fit into the technical stop loss. If you ask me, that's how I trade the markets anyway. I make that technical stop loss fit into my money management, my risk management. So again, here we go again, another nice opportunity. Again, I drew a zone here because we had this wick here. And then you can see where we spiked above this level. Look at the relevance here. This is the bar right here. And if this is that kind of bar, look at this bar compared to this and this. These two are about the same size, right? So look how big that bar is. Look how big that is. And look where it closed in its upper top level. But look where this one closed in its lower quarter. It should not even close below its midpoint. We want to, if this is true, this should close on the upper port like that. It should be up here closing. Therefore, this alerts us really quickly of what's really happening with the market. And therefore, we're able to put an entry below that level. Now, the market does do something that kind of confuses us a little bit, because it gives us this bar here, this candle here, major supply coming in. But with that major supply, we close on the upper portion again. So now we're like, okay, if you look at these two candles put together, they're one big indecision candle. All right, so now we really are confused. But to me, guys, if you have that supply coming in, you should still see that follow through if it's gonna, or actually if this is demand, if we see demand coming through, we should still see the follow through. And we didn't see the follow through because the follow through would mean we're closing above our high. And we don't see that. So therefore, the supply is coming in, starting to take over, because it did push the market down this deep. The demand was able to overcome it, but the next bar is really what happened. By then, if you wait for that, you're not able to get into the trade because you're well off the level. You surely don't want to be trading down there. So you don't get an opportunity to trade this market, because you should have been in the market. At least the lowest is up here. All right. Again, we got now another one, which is going to be your springing off the bottom. All right. It's like a pogo stick. What happens with that is, on a pogo stick, it drops down and pushes it right back up. You ever know what them pogo sticks are, with the two legs, with the one pole, and then the two areas where you put your feet here and then you hold on here and you jump up and down, up and down? That's what this spring is. It pushing it down, then boom, right on back up to the up top. So that's what we're looking for with the market here. And in this case, we made this multiple low right here when we came back to that level, and we had major supply coming into the market. But you can see what the candle told us. The candle told us that no, that wasn't major supply. There was a lot of buying in this area, a lot of demand, which pushed this off of its midpoint all the way up in its quarter, closed up in that area, and therefore we knew what was happening with the market. We should have been able to get into the market at that point. And this one would have been hard to get in because it's off the level, and I want to always put my stop loss below the low or the high, depending on the direction I'm trading. And depending if I was able to afford this, I would take this trade. The farther away from this level you get, the more risk you have, because I believe you always have to keep your stop loss at the low. All right. Some people don't do that. They say, oh, I can afford 20 or 30, and therefore they're not being technical with their stop loss. They say 20 is right here. They get in here and they say they can afford a loss here. Well, my goodness, the support is right here. You need to be at least below that point. So if that's all you can afford, then you can't take the trade. Right? So understand that. Right here again, we have another low here that created support. As you can see, we have basically, look at the bodies here, and then the wicks form a nice zone down here. And this is the low of the zone. Whoops, I went too low. But anyway, you get the picture. This is the low right here where this yellow is. Well, we pushed through that level. Look what's happening all the way down here. We're getting nice supply coming into the market, right? But the candle's getting a little smaller. All right. And as the candle gets smaller, then you could see basically the next candle shows us some demand coming into the market. Look at putting our order in there with a stop loss here. Triggers you in. We get a test of the up thrust of the spring, and then the market moves higher again. So a lot of times in these moves, you want to see shortening of the thrust. If I can show you. So on this case, I can't show you, but I'll show you on another one coming up maybe. But anyway, again, we have another spring opportunity. So with that spring opportunity, we developed this support level down here, made it into a zone. Price came down. You could see the three candles that were right here. This candle, now take notice, guys, this is an easy sign right here. This is even bigger than the previous two candles. So this bar is bigger. So this shows us that more supply is coming into the market, even more than the previous two bars. But the results not showing us the same thing. It closed a little bit above its midpoint and it rejected off of that level. It should close like these bars did, right? Therefore, that would help us to know that maybe it's going to the downside. In this case, closing like that on a support level is a very good sign that this market is not going to go below that level. Therefore, we would put our entry here, stop loss here. The market triggers us in. There's no follow through to the downside. We get that demand coming in and boom, there we go. All right, nice trade, nice opportunity looking at the market in that aspect. So again, here's another opportunity. Look at how this strong support is holding here off of this level way back here. And then we come here again, hit this level. We didn't go below this level. We came right to this level. But then over here, we came back a few more times, but then look where we did right here. Let's get closer to look at that and see what's really happening here. What I want you guys to take notice of first again is the volume coming into a level. Pay attention to the volume coming in again. Again, look at the increase coming in. That increase tells me that there's strong supply coming into the market, going to this downside to this level, these last three candles. But there's something that really lets me know that there may be an issue here. The last candle, it's the biggest bar of all, the biggest volume bar of all. But it's the bar is not the biggest. Maybe these two bars are the same size, maybe. But look where this one closed on its low, and look where this one closed. With this much supply coming into the market, this should close on its lower point, just like this one did. At this support level, if it doesn't do that, that's a bad sign that we probably won't break through this level. Therefore, that lets me know that we're probably going to see the market bounce on this level. So therefore, we do, as we see the demand coming in on the next bar, see the demand come in right here, and market pushes off. Now the market comes back for a test of this spring, of this support level, all right? And as you see the market dropping to this level, this is a good sign here, because what's happening is you're coming into this level. To go lower, you still need more volume, more to get down lower than this point here, you need more supply coming into the market. This is showing us less and less supply coming into the market. And therefore, we start to get these candles that are indecision candles. And the next thing you know, the market goes back to the upside. All right. Things that you want to be aware of when you're trading these levels, because these are all, again, what you guys want to say is liquidity grabs. That's all these basically are. So here's another opportunity here. As you can see, low here, another low here. So we got these equal lows right here. But the problem is this spike below that low. So on this equal low, they spike below. We get a big, nice volume bar showing us that supply was coming into the market at that point. But the candle doesn't tell me the same thing. We get the effort, but the result doesn't match. Why doesn't the result match? Because the result closed almost at its midpoint. If that result was true, because look at the volume, this volume bar compared to everything else. It's one of the bigger bars. I would definitely think that I'm going to close on my lower portion down below this level where I pierced, but it doesn't. And that's a major sign. That's one of the highest volume bars in this area. So for me not to break this level on that kind of volume lets me know that, hey, there's some demand coming in with this here. And I think that we're going to bounce on this level. Do we have follow through? No, we don't have follow through. So therefore, you start to see the demand come in and we get into the market. Boom, takes us right back up to the level. Now, the thing about this was the end of the day. This is the futures market on the ES. All right, so trading this S&P 500, what happened here, the end of the day, so around 3:30, you're going to get this big volume because you got, and it could be misleading sometime also, because what's happening here is the traders are exiting their positions. You got all type of volume coming into the market at that point. All right. Let's talk about these things as far as being in trends. So upthrusts and springs can also take place in a trending market. It doesn't have to be just a flat ranging market. All right, it can be also a trending market. So here at the yellow line, we have a high created from a corrective move. All right, so we have a high created from this corrective move. Well, actually, sorry, we're back here. Corrective move created this high, and then it formed that resistance point. So that high created the resistance point. So to the left of this high, you can see the market's in a downtrend because we're making these lower swing lows. And I call these lower bear fractals. All right. So you always want to pay attention to the structure of the market, and you can tell what the structure of the market is easily. There's a couple ways. And this is what we're seeing happening right here. These are swing lows, but they're actually bear fractals. Bear fractals. So the market, and then here's your bull fractals, right? So what's happening is the market's not breaking bull structure, which would mean if it's breaking bull structure, we're probably moving to the upside. Instead, it's breaking bear structure and keeps going down, breaks bear structure and keeps going down, breaks bear structure and keeps going down. Now, when it comes back to this bull structure, what we have here, which is right here, coming back to this bull structure, because this is a bull fractal, and it breaks that level, that lets me believe there's a possible change of character, a possible change of structure. So we may be seeing a change into the trend to the upside. But usually it doesn't just take place like that easy. A lot of times this level would be a level where we start to flatten out and go rangy. So what's happening here now is as we approach this level, all right, so again, first of all, guys, if you pay attention to these fractal levels, right, what's going to happen here? The market drops, comes back, and you get an opportunity to trade. Again, this would be an ICT breaker block. Or it would be a chaos trader fractal bounce. Or a Nichimoku S wave. All right. All these three things are the very exact same. The exact same. No difference. All right. But in this case, this fractal level creates this point where the market breaks, pulls back, and we trade it short. All right, that would be one opportunity. And I continue to watch this throughout the day as the market moves, makes another low here with this bear fractal, breaks the level, and then it comes right back to the level right here. And I make this into a zone, and we're into a trade there. All right, and then now my zone where I had that fractal for my last trade short, the market's coming back. Now I could again look at this as another fractal bounce, but what it also is doing is like here would be my upper zone, and this is the high of that zone, the high price point of that zone. And look what the market does. It spikes above it once and goes even higher, leading traders to believe that we have a change, break a structure, change to the upside. They're jumping into the market to get into this trade because they're too quick to see what's happening. They're not understanding what's happening with the volume, and they're not understanding what's happening with major structure at this point. So therefore, they're taking these long breakouts. The market just doesn't all of a sudden change direction and give you a big trend like that. Now, sometime it does. It could. All right. And especially on the lower time frame when you're like scalping, you could see things like that. But in this case, look at the weakness that came. So first of all, we did have nice volume coming in. But the very next bar, we didn't follow through. We had nice demand come into the market with a rejection of the upper level. So at that point, we should have been looking for a short trade, right? If we're looking for a short trade, we could put our entry in right there. Stop loss here, trade down to this low, and then maybe down to this low right here. All right, that's the day low. So that's what we see at this level. That's what we're seeing with these with these up thrusts and springs. Again, we got a few more that we're going to look at here. I'm going to go over these quickly because I don't want to waste a lot of your time. But again, you can see the market's in a downtrend. What's happening is we're breaking bear structure, right? We failed to break bear structure here. Then we dipped through here, came back up to the market, made this equal high right here. But as we created that equal high, we dipped above this high here. So therefore, that was known as an up thrust. What we saw was coming into the level. Now this time it's a little different. Coming into the level, you could see the increase in volume. So I would believe we're getting stronger coming into the level. But with this bar here, if it's coming into the level, it's the biggest bar. But it closed on our midpoint. Look where the close is, guys. If this is going to be relevant, it should close on the upper half up here. Or it should close on its high, at least, up in that area. But it doesn't. And then the next bar is a big bearish engulfing, and the market drops to the downside. And you can see it's all she wrote from there. So these are the kind of things you want to look at. Pay attention to that volume. It's going to help you to understand what's going on with the market much sooner. All right, and you'll be able to trade these levels. So again, another nice move here. So as I told you before, we trade these this up thrust. This up thrust happens in a trending market also. This is a bearish trending market. So with this bearish trending market, we're breaking this bear structure right here. All right, so in the process, the market breaks this structure, pulls down here. Now again, this gives us again another trade like I told you on the previous one. Again, we would have right here would be our fractal. So the market breaks and we pull back to that fractal and we get into a short trade there. But in the process, the market comes back again. This high right here is violated with this candle right here. Going into that level, we had two, let's go back. Let me erase this stuff. We had two bull bars coming in right here. These two right here. Then we had a big volume bar come in for showing us that supply was coming into the market very strong right there. But how would we know here? It'd be a little bit hard on this one because this was nice result based off of the effort, pretty much matched. And so therefore we would have to wait to see if we get follow through. And in this case, we don't get follow through. The way to trade this, now you get a outside bar, you also get a big bull trap, a major bull trap, because first of all, what happens on these traps, it goes above the high and then closes below the low. That's a classic bull trap. All right. So the thing about that, it's a classic liquidity grab. All right. It's a classic upspring, up thrust. All right. It's classic. But the thing about this, guys, how would you get into this trade? Let me show you real quickly. How would you get into this trade? If you trade the direction of the trend, don't consider that break of structure. Let break of structure prove itself by breaking and coming back and not breaking back below, and then you can trade. So always trade with the structure, and if the structure is bearish, then look for the short. Therefore, you know that once the market went to this high and even broke that a little bit, I would put my entry one of two places, either at the low of this level here. I could even put it at this level. But since that's tight to the market, I would put it at the low of the range of the zone with a stop loss slightly above the high, and I'm in the trade instead of waiting for the market to violate this level or close down here, way down here. Sometime if you wait on that confirmation of a bar closing on the next low, you're not going to get the trade because it could be too far. So you trade common sense, which is going to make you have that level and not much of a stop loss. And therefore, you're not risking much, and again, an opportunity to receive much. All right. So that's what we're looking at. Let's look at this opportunity here. This is going to be my last opportunity. Then I'm going to show you a schematic real quick, and then I'm going to be out of here, 5,000. But in this case, this is a bullish market. Why? Because here's bear structure. Now, we're breaking, this is bull structure. We're breaking bull structure. Look, all the candles break bull structure. No candle broke bear structure. No candle broke bear structure. Came back and and bounced off bear structure in this case. But let's talk about this. So therefore, you should be looking long. If you're looking long, as the market comes down here, I can go back over here and show you again. This is another fractal opportunity. First, before anything happens, before I get any kind of spring, I get an opportunity to trade long right here, bouncing off of this structure level, this bull fractal. But then also, the market comes back equal low. Well, it violates that equal low hard, big time. And what it gives me is a big sign that this may not hold. It's not showing me follow through because, first of all, guys, look, this bar, actually it looks stronger to me on this bar, but this bar was smaller. So I'll give this effort and result pretty much a good sign that this is going to break. But guys, when the market comes all the way back up and gives you big demand like that off of a big bear bar, these railroad tracks, then you know what's happening. It's going the opposite direction. So it does go the opposite direction, but the market comes back, gives you a test right here, and then it goes your way. This would have been a hard trade to get into unless you trade the way I'd have been telling you. Don't trade the break of a level. You know, use that level as always a point where you could get into the market. So as the market was way down here, I could put my entry here or here, let it come up and trigger me. If it's going to come back down, it's only going to come back down to that candle. But if it's going to go, it's giving me a lot of profit. All right, so that's what I would be doing. That's what I'd be looking at. So that's going to be basically your thrusts and upsprings. I'm sorry, I keep saying your up thrusts and your springs. I just love to say that upspring because I'm thinking about that pogo stick. I don't know if you guys know about pogo sticks because you guys are probably too young, but some people around my age, you probably know about jumping on that pogo stick. But anyway, let's get to our last slide here. What this is basically just talking about the Wyckoff accumulation schematic. So it also is going to be, I'm not going to get deep into this. I'm going to show you real quickly, but the market's trending to the downside. As it trends to the downside, we get this point right here, which is going to be this preliminary support level. It's the first level that appears signs of stopping the trend to the downside because we start to see demand coming into the market based off of the candles and the size of the candles and also the volume. But as that takes place, our next event is going to be the selling climax. So we get a selling climax. Selling climax usually occur with big volume bars that don't line up. It's a lot of times it's a big climax, and then the next thing you see is demand coming into the market, like you see here. So we get that, and then we get the market pushes back to this automatic rally right here. So the automatic rally, it just basically establishes the upper limit of this accumulation level. All right. So that's what it does. It establishes the upper point of the accumulation level that this market is now in. It's in, this is going to be phase A of this Wyckoff schematic. All right. So that's where we are with that. And then the market comes down to this level right here. You get a secondary test. So the secondary test is where price returns to the selling climax to test the supply and demand balance in this area. And in this case, there's no balance because it's basically a more demand than supply, and it pushes the market up to the upside a little bit. So it tests that selling climax to see if this is actually true, if this is actually true demand coming into that market. And it showed that it was. All right. So as that takes place, let me get my drawing tools here. We get this right here, which is going to be your secondary test in phase B. So phase A ends right here. And then we get phase B, and then we get this secondary test. And then on this secondary test, it's just price returning to the selling climax area to test again, basically like testing that supply and demand again, and just testing to see if this level is going to hold. Right, and again, it's established with another big bar. A lot of people will get caught up in this and think that it's going to be a spring. And you could think that, but it doesn't go that far All right, so it's really not a good spring here, and it doesn't go that far. It could have given you profit a little bit, but the real thing happens right here is when this market comes down. You created this low here, then you made a secondary test that made another low. Then you came down for equal lows, but you violated it. You broke below it, and on the process, you had a nice size bar, but your volume wasn't the same. So the effort and result were not equal. All right. So therefore, we saw the demand come into the market. Erase that. You saw some demand come into the market, pushes off that level. Then it pushes up higher. This is basically where we see this resistance point up here. Market pushes up. Last level of support. Breaks through that level. This is your buy up area. All right. So you get this nice buy up. Then the market gets signs of weakness. All right. And those signs of weakness, actually, I'm sorry. That's in my downtrend. And this is the signs of strength. So on the signs of strength, we see strong demand coming into the market. How do we see that? We see it basically because, first of all, you got this little area here and you had a push down that didn't violate. And then what happened next was you could see we pushed off of this level with nice three big candles. So this area would be your signs of strength area. And then the market moves up higher. All right. And we're now into this uptrend markup. And then you would get up into the next area, which would be you have your accumulation, right? And then now the market pushes up here. And then the market starts to do the same thing at the top, which would be your distribution, right? So if it comes back up after a nice long rally to the upside on the markup, you get this distribution, which would do the exact same kinds of things here. But instead of seeing a spring, you would see an up thrust. All right, you would also have your AR here, your SC here, and your ST. And then the market pushes back down. Now you can have a secondary accumulation, and then the market pushes higher, and then maybe a third accumulation, and then finally you get distribution. Now what I wanted to show you finally, last thing, if I can, shortening of the thrust, and that's how we look for these springs in this area. So the shortening of the thrust would be how far are these going, like these lows here. So it would be hard to really say that we did have real good shortening of the thrust, because this last level where we had this selling climax, these areas are probably equal. All right, maybe these are a little bit bigger here, but there wasn't much shortening of the thrust, and it wasn't anything that would have alerted me. Shortening of the thrust is this basically when you see the market doing this. So what happens is you have from here to here, from here to here. These two are about the same, but then here to here you get short, and then here to here way short, and then finally you don't break that high, which then could probably form a head and shoulders or something like that, or your nice range, and then the market drops to the downside. We'll talk about all that on another video. Right now, just wanted to get you alerted to these up thrusts and springs. These are things that you're going to be able to look for in your daily trading when you get to equal highs and equal lows, basically. But also look at and mark your support and resistance levels, and then look to see what happens with the market at these levels. Watch the volume at these levels, very important, and that way you'll be able to catch these trades. Did I take an hour again? I probably did, and I'm sorry if I did, but hopefully it was worth that hour. Guys, please, if you're not, if you haven't been watching a lot of my videos, please go back, watch some of my videos. You'll see that some of the things I talk about may interest you. Okay, so what you may want to do is subscribe. Give me a like if you did like this. And then also hit that notification button, because that'll let you know when I put out another video, because I'll be putting out another one this week. And I'm going to talk about strictly liquidity and how to find these liquidity levels. Basically, I just showed you how to find liquidity levels, but I'm going to get a little bit more detailed and a little bit more different. All right, so that's what we have here. I'm about done. Hopefully this was a blessing to you. Hopefully it was something that could help you in your trading. And until next time, guys, have a great one. God bless. So long.